Howdy, Jacob here. Today we're looking at the company AngloGold Ashanti, ticker symbol AU. Who would have thought the periodic element symbol for gold? They operate as a gold mining company in Africa, Americas, and Australia. The company explores for gold. Its flagship property is 100% owned. Blah, blah, blah. Okay. Actually declined in revenue over the last 10 years. I wonder if there was any sell-offs, but I know the price of gold is pretty volatile, and with mining companies can be, again, very volatile. With, yeah, no surprise here. Cost of goods sold is really the majority of the cost here. There's not a lot of sales and general admin. It's basically, roughly in line with the price of gold because the cost of attaining it and digging for it and everything is kind of fixed. So it's just going to be the price of gold that really fluctuates their earnings. And share count up a little bit, not too concerning though. The last couple of years pretty flat. 1.1 billion cash on hand, 20 million short-term debt, 1.9 billion long-term debt. Cash or debt is down though from 10 years ago, so it's good that they've at least historically been able to find ways to reduce that debt figure. But 2 billion of their 5-year average free cash flow is, let's say, I guess be generous, maybe 400 million. So that is 5 times. But again, they do have 1.1 billion in cash on hand. So it is about more like 2.5 times their net debt. So not the biggest concern here. The dividend pays out 210 million. That is about 50% of their 5-year free cash flow. Not a whole lot of reinvestment, not a whole lot of acquisitions, not really much else to do here. So I think I'm comfortable with them paying that dividend just because this type of business, I don't know what else they would necessarily do with that money. I do like the opportunity to buy back shares that are stupidly cheap. But again, we don't know whether they're there until we do the analysis. But I still like having the capability of doing that. And otherwise, that debt reduction figure due to them having a little bit of debt. They have a lot of cash on hand, which is very healthy, but they also have a good amount of debt there. So let's start making some assumptions. Revenue growth, I'm just going to go with inflation here. Let's do 3.13. Margins, pretty close to averages here. Pretty big range, 8.12. Share change, keep it relatively flat. Yep, most obvious sensation. Dividend, probably could increase that 3% a year. I feel pretty comfortable there. And we get to a price that still needs to fall 68% before we get the return we're looking for here. I don't know. I feel pretty comfortable with this. I just don't see it being a screaming deal right now. I think that there's way better deals out there. Don't waste your time unless you truly understand the business. You really think you've done your analysis. It's a great deal for you, but for me, not at this moment. So hope you enjoy the name of the rest of your day. Thanks.